Cap rate. You'll hear this one floated around a lot. Those of you that are a little more savvy and are dealing with more than one or two houses, if you're dealing with multifamily properties, etc., you're going to be using the cap rate formula. This is capitalization rate, and it will be super beneficial when you're comparing beneficial return on investments among different properties that you want to purchase. This calculation is more complicated. It involves a few extra steps. I've got a great spreadsheet that at least help you get started in understanding cap rate. And yeah, you should probably use some of your own investment properties in the cap rate model so that you get used to the reality behind what is cap rate. Ultimately, you're going to be calculating net operating income, we'll call it NOI, divided by the purchase price. That's going to give you a capitalization rate. So you determine the NOI by calculating the annual rental income, just like we did before, except at an annual level, and subtract the total operating expenses for the year. Now, I'll give you a story to support this, right? So John owns a rental property, generates $3,000 a month in rental income. That's $36,000 a year in rent collected. Annual expenses, which will include mortgage payments, property taxes, insurance, maintenance, amount to about $1,000 a month, so $12,000 a year. You're going to calculate the NOI by the $36,000 of rental income that's collected minus $12,000 in operating expense. That's going to give you $24,000 in NOI. On to step two. Must have the NOI formula completed first. This is now you determine the purchase price. What am I willing to pay for it? So to find out the total purchase price of the property, the total purchase price needs to include the property cost, closing costs, inspection fees, and any necessary repairs or renovation to get it, again, rental ready. So property price is listed at $250,000 plus $15,000 in closing costs, plus $34,600 in repairs and renovations that are required to get the property rental ready, plus a $400 inspection. It's going to come out to $300,000 in total purchase price, money out of pocket or invested day one. That's going to give you the purchase price standard that you need to finalize this calculation. And then step three, you'll calculate the cap rate by using these two formulas above, the NOI divided by the purchase price, total purchase price. That's going to give us our cap rate. So the $24,000 we talked about in step one divided by the total purchase capture price of $300,000 is going to equal 0.08 when you divide those into each other, or an 8% cap rate. Believe me, anything over a 5% cap rate is great. Anything over an 8-9% cap rate is sensational. Jump on it. Don't even think twice about it. When you got a cap rate of 8%, the percentage is going to be the property generating an 8% return on an investment on its net operating income. The higher the cap rate generates a more profitable investment. You're typically not going to get higher or much higher than 8% because the people that you're buying it from also understand how to calculate this, and they have the real numbers. So they're going to be selling it at anywhere between the 5 and the 8% cap rate. You're using this formula to validate what you're willing to pay for it. If your margins need to be higher, if you've got some additional wiggle room that you can take a lesser margin because you're going to make some increases later on. It's an older property. It's been rented for a long time. They haven't done a lot of rental increases, etc. We'll talk about that later on too, and how you can improve. Buying a property at a lesser cap rate does not necessarily mean you can't get it to 8% above, but it does mean that the person in front of it currently doesn't understand how to have the strategy or hasn't been put in a position as the current owner to be able to increase that benefit. So that will move us into what are the factors that will affect that cash flow. A lot of things happen, and in Florida, we've got some unforeseen circumstances, storm elements, hurricane elements, etc., additional insurances that you would not necessarily have in other places in the country. So It will be important for you to understand what all of those variables are, and maintaining that positive cash flow is ultimately what you need. You can't continue to be an investor if all of your properties are negative swing, and banks won't continue to lend money, quite honestly, if all they see is you making bad investments. So let's talk about the things that influence that cash flow the most. Naturally, the one thing that I repeated all the way through those formulas: expenses. Large negative cash flow items include operating expenses like mortgage payments, property taxes and insurance increases, maintenance, utilities, and property management. If you're going to pay a property management, their fees need to be capitalized inside of the services that they provide. They need to be able to show you where they're minimizing the expenses because of the consistent management strategies that they have in place, the consistent oversight that they have for your tenants, so that bad things aren't happening to your property when you're sleeping at night. Their job is to keep an eye on it and keep those fees to a minimum. Other current and non-recurring expenses that will impact your profitability could be major repairs or emergency repairs. And hopefully, you're putting good tenants in place, you're vetting tenants that have a good history in properties before yours that will guarantee that they're going to keep those expenses to a minimum too. Rental income is a big one. How much you can charge for rent depends a lot on the location of the property that you've purchased, the property's current condition, and the market demand. High vacancy rates or high turnover rates, lower rental incomes will absolutely hurt cash flow. And you can look at an area, you can look at a particular group in town, just like when we do assessments of what a residential property should be valued at based on the market approach. We check an entire city or piece of a city to show how many rental properties are there, how well is the rental rate returned, and how are we keeping the lower rental incomes out of these areas. Which of course brings you to vacancies. Rental vacancies themselves, the more vacant a property is, the less money that it's going to collect, right? Our formula is perfect half, that is 12 months of income. You're going to put a little buffer in there so that, if you miss 1 month during a transition, that's one thing. But traditionally, if you are not renting your property at least 11 months out of a year, your property is going to severely hurt the amount of income that's supposed to be working, and it'll crush your cap rate. So you want to have effective tenant retention strategy. If you're using a rental management company, they need to understand how to keep your tenant happy. Your tenant's paying on time. They feel like that's an obligation that they have to do. The rental incomes are hitting at the right time of the month. You're not having to chase them down and cost yourself additional fees for the chase. And they are keeping the property under good condition, under the watchful eye of yourself or a management consultant. Effective tenant retention strategies and screening processes are really going to minimize vacancies, and it's going to keep your property cash flowing, which is ultimately your goal. Market conditions. You better know the market. You better know the market you're in. And if you're an out-of-state investor and you bought a property in another state and you're having to try to manage it across state lines, you're putting yourself in a risky situation. Economic conditions, interest rates, local real estate markets drive rental rates and property values. And as a general rule, everywhere in the country, rental rates consistently increase year over year. You may have restrictions in your lease on how much you can raise rents, but ultimately, when you transition from one tenant to another, it should be an easy opportunity for you to go in, clean it up, get it back to its newest level of quality, and rent it at the newest rental rates in your area. Shifts like this can be negative or positive against your cash flow, so you really need to keep an eye on your market and how it's affecting the current property that you have invested in. Which brings us back to property management. Good property management companies will keep the rent collection, the maintenance, the tenant relations, and all of that in check. It's going to provide steady cash flow for you. You're going to be able to sleep at night, not wondering what's happening in your property today. Poor management, however, will absolutely increase the vacancies. How they are managing their tenant relationships will raise expenses, and it'll ultimately cut into your profit margins. And if you took a risk and bought a property at a lower capitalization rate, say in the fives or the high fours, you will be in a position to where every one of these little mistakes will drastically affect the margin for you to be able to capitalize on it. So keep these factors in control. Investors will typically have some type of inflow of cash to make real estate investing profitable and sustainable. There are rent collection platforms to help you keep an eye on things as well, Mr. Investor. If you are working with a good management and strategy company, they should be giving you at least quarterly reports to show you how's the property doing, what are the adverse conditions of your market area, whether or not you should consider buying more properties in the same area to continue to help support the investments you've already got. These are the kind of things that are going to help you manage it more effectively, and they're going to help you as a property owner maintain that consistent income, reduce the administrative effort because you understand what's happening, and focus more on growing your investments. So now you've got the properties, you've got everything moving in your direction, you've got positive cash flow. How do you increase it? How do you get yourself into a better investment standing? Unlike the stock and bonds market, you can directly affect how the cash flow works. And no, it's not just as simple as raising the rent, but that's certainly a part of it. Increasing your cash flow is going to require raising some of the income and reducing some of the expenses. Having that strategic approach on how you should manage that every year for your properties as part of your investment business plan will radically improve your profitability. Some of the hands-on tips that I can tell you for managing this, and we manage quite a few properties at Keystone. We do it, again, at a very analytical method. We make sure that our clients understand what's going on with your property, what do we see happening in your property 12 months out. We help you plan for the success of your investment, and not just that, but the overall growth of the property too. How's this property looking to fare in the current market strategy 1 year, 3 year, 5 years out?